So, is there a risk hiding in your index fund? Plus, with all this COVID stuff going on, how on earth is the housing market still hanging in there as much as it is? We'll also talk a little Tesla today as well. That company and that stock certainly getting a lot of attention amid speculation of its inclusion in the S&P 500 index. What does that mean for you? So we'll cover all of that on this week's show. Thanks for joining us here on Dollars and Cents, longest running radio program in Central Florida, where each and every week we help you make sense out of all of life's decisions involving your dollars. Coming to you on Sunday mornings at 9 a.m. in Central Florida on the News Radio WFLA Orlando Network and 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web with over 10,000 downloads of our program at last count. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that provides you with peace of mind for the future. Before we get to our host of topics on this week's program, we thought we would do a little bit of a grab bag of topics, something that we do from time to time when there's a number of interesting statistics that all sort of come to us at one time, and we start to put them together and say, well, this seems like some pretty interesting information to share on the program, or if you like, in the immortal words of CNC Music Factory, things that make you go, So here we go. Dating back to the 14th century, this one's particularly appropriate to today's world. Dating back to the 14th century, 100 years that began January the 1st of the year 1301. Not counting the current COVID pandemic, there's the tie-in to the current headlines. We're not going all the way back to the 14th century without tying it into the current headlines. Not counting the current COVID pandemic, there have been no less than 15 pandemics where more than 100,000 people have died. Think about that. Back in the 14th century, the 15th century, the 16th century, 100,000 people, that was a lot higher portion of the population. Kind of some interesting numbers there. Right now, speaking of COVID and the current pandemic, right now, according to the Millikan Institute, and that's fascinating on different levels because Millikan is in fact the name that we're talking about in terms of that Michael Millikan, who was the junk bond king of the 80s. According to his institute, see, he's kind of reinvented himself as having a charitable institute, there are no less than 197 vaccines for COVID that are already in the development stage. That's pretty good. That's some really good news. And not as an aside, I'm not sure if things will really get back to normal around here in the absence of a vaccine. So it's great to hear that there's 197 vaccines in the development phase at this point. And I guess speaking of death, that's sort of a rough segue, isn't it? COVID to death. The other statistic I saw that kind of surprised me was that 55% of Americans, as of May of 2020, so this was pretty recent, did not have a living will in place. Now, remember what a living will is. It's a document that details an individual's sort of end-of-life decisions that they want to be carried out when they get to the point that they don't have the capacity to carry them out, but they're still alive yet. They're not dead yet, in the immortal words of Monty Python. We're quoting a lot of references on the program this morning. And so they lose their ability to communicate, but then you refer back to the document. The living will document is otherwise known as the pull the plug document. That's sort of the rough translation of what the living will is, but it basically allows you the opportunity to sort of lay out your wishes when you get to the point where you can't really lay out your wishes. So folks, that's an important one. And the fact is that the majority of the population does not have one. And the very simple recommendation is it's not an overly complicated document. It's not a whole lot of decisions that are going into it. You just need to decide how you want your end of life to be, which may be a little bit more thought-provoking than anything these days, and name somebody as someone who will ultimately make sure that your wishes are upheld. So simple document, not a whole lot of decision making that goes into it, and the ability of anybody to get a hold of that type of a document, a form document, on the internet, pretty easy to pull down something along those lines. So if you're part of the majority who does not have a living will, we want to take this opportunity to use that statistic to encourage you to actually get one. Shifting gears, again, this is the segment that we are referring to as the grab bag, right? Things that make you go, In addition to high taxes, you do not want to be a landlord in New York City these days. Why? With the federal moratorium on eviction and the ability to charge late fees for late rent that the CARES Act instituted, there's an estimated 25% of the 5.4 million renters in New York City who have not made a monthly rental payment until March of 2020. We understand that many of them are struggling. Certainly New York, subject to one of the harsher shutdowns, if you will, and certainly the economy there is in deep trouble. But that's a pretty significant statistic when you think of it. 25% haven't made a rent payment until March of 2020. And that's why, as we talked about on the program last week, when we were sort of starting to speculate as to what the next stimulus package might look like that comes out of Washington, that's why it's likely that the stimulus package is going to have some form of a money to landlords, to tenants, things like that, to really kind of help that situation out. As opposed to other investing options and things like that, here's a statistic that should get your attention. If you're thinking that investing options out there have sort of declined over the years, this statistic will certainly get your attention on that. The number of publicly traded companies, meaning a company that anybody can purchase on the open markets, on the open exchanges, the number of those companies has in fact declined by quite a stark number. In 1996, that's about 25 years ago, there was a total of 8,090 publicly traded companies. Today, that number stands at roughly 4,397. That's a pretty significant shift in the ability or the availability of different companies that are out there. That's certainly a surprising sign of the clear consolidation that is happening during the course of the past 25 years of a consolidation among industries. Well, that's just some interesting stuff, a little bit of a grab bag segment. When we return, we're going to shift gears and talking about some of the hidden risk in your S&P 500 index. Coming up next here on Dollars and Cents. So are you like many investors these days and own the S&P 500 index, whether that's through a mutual fund or an ETF? I mean, the reality is most folks do in fact own that particular index because it's the most widely held index in the financial markets. And so what an index fund is, particularly the S&P 500 index, it's supposed to be a basket of 500 stocks, but there's a little math concept that is really wreaking havoc on the underpinnings of that index. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner and certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries located right here in Central Florida stand ready this week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So, what's the mysterious math concept that's wreaking havoc on the S&P 500 index? Well, it comes down to the difference between an average weighting versus a market weighting. And it's important to know the distinction because it's going to tell you a very different story than, oh, the S&P 500 index is simply a basket of 500 companies. It's a basket of 500 companies, but different ones have a much, much greater share of how that index performs. So let's go over the concepts. Obviously, average, we know what that is, right? If I got an average of 500 companies, that would seem to me like I, add them all up and then I divide by 500. And in that case, a mathematical average, everybody has an equal weight to determining what the end result number is. Well, the index doesn't work that way. It works based upon a weighted average. So what that means is that the bigger you are, the more you wind up driving the performance of that particular index. Today, just 5 names account for over 22% of the S&P 500 index. So it's really like the S&P 5, because you got 5 companies that are accounting for over 22% of its performance. The other 495 are like, the redheaded stepchild, if you will. The 5 that are the names that are driving that much of the performance of the S&P 500 are certainly names that we are all very much familiar with, whose business models, even during the course of the COVID pandemic, have in fact grown because the need for their services has only grown just by happenstance of how this particular economic situation has played out. And so the 5 obviously are, the FANGs or the whatever folks refer to the acronym on, but it's basically Facebook, Amazon, Apple, Microsoft, and Alphabet, which is also known as Google. Some folks toss Netflix in there as a 6th one, but we're just going to talk about the top 5 because there's some interesting statistics and comparisons that we want to draw your attention to, particularly if you're owning that 500 index fund. So those 5 stocks, Facebook, Amazon, Apple, Microsoft, Alphabet, also known as Google, make up 22% of the performance of the index. So that really just throws some serious questions on the diversification and what that index really represents. I mean, I think traditionally you think of that index as representing a pure cross-section of the overall economy, and that's certainly not the case now if you've got 5 companies, all of which, by the way, arguably sort of in the same sector of the economy. It's not like there's a real estate company, an energy company, a tech company, a pharmaceutical company. I mean, those are all pretty much within the same sector. So you really have to question the premise that the 500 index fund or ETF really represents that broad cross-section of the American economy. And as we were saying, during the course of this pandemic, those 5 companies have added more than 1/3 to their values in 2020. So those 5 companies have seen a pretty significant increase in their values as businesses. And as of a week ago, their performance, if you look at the performance of those 5 companies, their performance had allowed the S&P 500 index to actually be up for 2020 about 2%, while the other 495 companies were down 5%. So that's how dramatic the numbers are. And it's led to one of the highest concentrations in those top 5 stocks in decades. Just how dramatic is that number? Well, let's look at some data. So 5 years ago, or a year ago, the top 5 stocks in the S&P 500 index represented about 16% of the index. Today, that's 22%. So it's been a pretty big growth rate in terms of how much the top 5 stocks are driving that index. For comparison purposes, let's go back, now it's 30 years, to the era of the dot-com bubble. The top 5 stocks then made up 18% at the peak of the dot-com bubble. You remember those names, 1999, 2000. The 5 names, of course, were different, with the exception of one. The 5 names back then that were the main drivers of the market indexes were Cisco, General Electric, my how things changed in 30 years, ExxonMobil, another one, things changed in 30 years, Intel, and then the one remaining holdover is Microsoft. Pretty amazing. 30 years ago, Microsoft was in that group, and it's still in that group. That is certainly an amazing story for Microsoft. But out of those 5, Cisco was sort of the darling. Cisco was the star, the one that everybody was most excited about. And at the peak of the dot-com value, Cisco was valued at 130 times its forward earnings, meaning how much money is Cisco going to make over the course of the next year? The valuation of that stock hit a record of 130 times those future earnings. For comparison purposes, today, Amazon stands priced at about 103 times those same forward earnings. So certainly some things to be aware of as it relates to your index fund. Those are the things that you need to be aware of as the potential issue that is lurking inside that index, because it's great when things are going great, right? But when things don't go great, then those 5 companies are going to have a disproportionate impact on the downside as well. Their impact is certainly skewing the performance, not just the performance, but also things like the dividend yield in that S&P 500 index. The total yield on the index is 1.8%. If you strip them out, the average company in that index has a dividend yield of about 3%. So be careful on this, folks, because if you look at the recent rise from March the 23rd, about 30% of that rise in the markets has come just from those 5 stocks. And as investors, we all need to be aware of this dangerous fallacy that somehow index investing is some safer version of investing. Index investing, particularly in the S&P 500 index, is the very definition of stock or equity investing that comes with all of the same risks that you would have in any other stock or equity portfolio. So be aware of that. What you should do as an investor is simply this: you need to check it out. Make sure that you run an analysis on your portfolio that looks at the underlying holdings that you have, to actually drill down in and look at the underlying holdings, because that will tell you just how much of an overweight you really are on those companies. And if you're concerned about diversification, if you're concerned about spreading around your risk, you certainly want to do that exercise to check that out. We'll return after these messages here on Dollars and Cents News Radio WFLA 96.9 The Game. So here we are in a pandemic, right? And it's having a dramatic impact on everything that we do. But when we look over to the housing market seems to kind of keep humming along pretty well. And so we asked the question, why is that? And we've got some answers that we want to share with you to get that conversation in perspective on the program today. Welcome back, of course, to Dollars and Cents. We're Central Florida's longest running radio program coming to you every Sunday morning at 9 a.m. on the Central Florida News Radio WFLA Orlando networks and 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. Over 10,000 downloads of our podcasts at last count. Here on Dollars and Cents, we strive to help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris of Nelson Financial Planning. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So what's going on in the housing markets? We have these massive job losses, but the housing market, by all accounts, seems to be doing okay. Last month, during the month of June, median home prices increased by over 4% to a record average median home price of just over $295,000 at $295,300. Well, why would that be happening? Well, as with anything, it always goes back to those sort of fundamental economic theories of the laws of supply and the laws of demand. If you have limited supply and higher demand, you are, by necessity, going to send prices up, right? If I've got 100 oranges and people out there are demanding that they want 200 oranges, well, then I can increase the cost of my oranges pretty good. That's kind of how, because I can certainly sell them because you got people demanding 200 oranges. So that's sort of how the laws of supply and demand look. And so we're going to apply that to sort of what's going on in the housing market. And the supply side, that's kind of pretty easy to see some of the limitations that are in there. In fact, there are 350,000 fewer homes for sale now than a year ago. Today, about a little over 1,570,000 homes for sale versus a year ago when it was a little over 1,900,000. So about a $350,000 less supply, if you will, in the market. And then on the demand side, lots of folks wanting to kind of move these days. There's tax reasons, there's relocation reasons, there's, hey, if I'm going to work from home, I want it to be maybe in a different location or a home that is laid out differently. And then, of course, the realization of how low interest rates really are. If you can, today, you can get a 30-year fixed rate mortgage at 3%. As an aside, if you're in the process of financing, you probably want to stay with a fixed rate mortgage with those kinds of low numbers. But here's the math. At those terms, 30 years fixed rate, 3%, for every $100,000 you borrow, your payment is a mere $421 per month. That's just incredibly low and just amazing. But beyond that, beyond sort of what we see in terms of the fundamental supply and demand, less supply, high demand, particularly with interest rates being what they are, we think there are other sort of three unique factors that are certainly accelerating and helping the curve. And one of them goes back to sort of the COVID pandemic and frankly the uneven toll that it is having economically. And what we mean by that is that households with lower income are being more dramatically affected than households by higher income. Households that have lower income generally are working in jobs that aren't easily transferable to a laptop, whereby the rest of the world, higher income, more easily transferable to the laptop. Here are the numbers on that. If you look at households making less than $35,000, nearly 60% of them today have lost employment income. If you flip it and look at households that are making more than 75,000, that 60% number drops down to 40%. That's a pretty significant gulf in those numbers. And the reality is, of course, that those that are making over 75,000 are certainly more likely to be in the home buying market than households that are making less than 35,000. Those are, for the most part, probably renting and things like that. So that's kind of one piece of the puzzle. The other thing, of course, is the CARES Act that really dispersed out a tremendous amount of cash, $1,200, and then the extra $600 per week on the unemployment. And then some of the flexibility that has been granted to homeowners in the CARES Act. You can go 12 months in terms of forbearance for a borrower if you have a federally backed mortgage. That's an option that today about 1 in 10, or to be precise, 7.8%, are in fact taking advantage of. So the CARES Act also kind of has some play in the numbers. And then lastly, the other factor is sort of the aging exodus, or what we refer to as the aging exodus. And that's made up of two pieces. It's the exodus that we mentioned earlier, where folks now working at home, hey, I've got limitless options as to where I can do that. If I just need a connection to the Wi-Fi, maybe I get out of the expensive, high tax, high rent city. Maybe I go to a smaller community that's more cost effective or lower taxes. That's sort of the exodus piece. And then there's the age piece. The average age of a home in America today is increasing. It's not decreasing, it's increasing. So those older homes and the average age getting older certainly spurs more new home in investment. So that's sort of the aging exodus that is also taking place. That we think is one of the factors that's also beyond just kind of the normal supply and demand that is helping to keep the housing market in shape. So that's sort of the background, if you will. And the question we get is, okay, well, so what should I do now? What, should I wait because home prices are high? Should I jump in? Like, what's the best strategy for me? And we think that if you are in the home buying market, you should stay in it. Chances are you're in the home buying market for a reason. It's not like you wake up one day and say, oh, maybe I'll just go and buy another house. There's a reason for it. There's, maybe more kids, or a relative, a parent is coming to live with you, or maybe you're looking to downside because all those people that used to be at the house aren't there anymore, or maybe you just want a relocation. But there's a reason why you're in the housing market as a buyer, and we think that if you're in it, that you certainly stay in it because there's a reason behind that. And the reality is that in our minds, it really comes down to more the financing. So granted, maybe the price might be a little bit higher than normal, but if you look at the financing and how incredibly cheap that is, that's going to be a bigger driver of how the home purchase plays out for you over the course of the rest of your lifetime. Remember, $100,000 at 3% is a payment of $421. And the reality is that that's a pretty unique opportunity that's only available now. But here's the thing, you would have that rate for the next 30 years. So we think the low cost of borrowing would encourage folks to, if you're in the buying market, to continue to stay in there. Coupled with the fact that I think the banks have been pretty stingy on loaning money. And so we don't see that there's some big lender-fueled activity in the real estate market like there was in the past. So some perspective on the housing market and what's going on there. We'll take a break and return after these messages on Dollars and Cents. Last week on the show, we talked a little bit about the spike in gold and sort of warned our listeners to sort of be careful about that. And I suppose this week we're going to throw Tesla in there as well. Not necessarily a comment about the individual stock per se, but really a comment about its potential inclusion in the index and what that impact is going to be on your index fund. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that provides you with peace of mind for the future. We don't often talk about individual stocks on the program, but we think that Tesla sort of deserves a little bit of a segment of its own, if you will, and some type of perspective, especially given the ongoing conversation about the potential and it seems likely inclusion in the S&P 500. Now, don't get me wrong, Tesla as a company, incredibly well run. Elon Musk, I mean, the dude's a genius. I mean, he's got like two different companies doing one's launching satellites and the other one's making electric cars. It's just incredible. And the cars are cool, phenomenal cars. And this certainly isn't, a stock pitch one way or the other. That's certainly not what we do, but we think it's interesting to see what's happening and then how that relates back to the indexes which so many investors own. You've got to listen to these performance numbers. The stock Tesla is up nearly 250% year to date and over 500%. That's 500% the past 12 months. During the past 52 weeks, the price has ranged from a level of $211 up to almost $1,800. Pretty dramatic. The market capitalization of Tesla today, based upon those stock prices, and remember, market capitalization is the concept of sort of how valuable a company is, and you simply take the stock price, multiply it by the number of outstanding shares, and that sort of gives you the idea of how valuable, if you will, in terms of dollars, a particular company might be. Well, if you do that math with Tesla, you will find that it is a completely skewed result. It shows that the value of Tesla is greater than the combined value of VW, Daimler, BMW, and GM combined. I mean, that's the perspective on it. That's significant. And it now appears, given its most recent earnings that came out during the month of July, that Tesla, in fact, is headed for membership in a very rare and esteemed club. And that club would be, of course, the S&P 500 index, the index of what arguably is the 500 largest companies in America. And the conversation has really peaked of late because Tesla just recently cleared a key hurdle for inclusion in that index, and that is that in order to be part of that index, a company must have a cumulative 4-quarter profit. And a couple of weeks ago, that's exactly what Tesla was able to do. So there's a lot of conversation about it ultimately joining the index. And so what does that actually mean when a company like that is joining an index? Well, it means that the index funds and ETFs and things like that, which and strategies that track the index, which didn't necessarily own it now, right? Because if I own an index that's the S&P 500 index and Tesla's not part of it, then I don't own any Tesla, period. Now, though, the index will be forced to buy it. Once Tesla gets included in the S&P 500 index, then all of these index funds and ETFs are going to be forced to buy it at, you guessed it, these super high prices. In the S&P 500 index investments, it's estimated that there's a record of $4.4 trillion in those. Recall earlier in the show where we were talking about just how concentrated it was with the top, with the top 5. Those investments that track that S&P 500 index would need to purchase a stock that today, based upon its price, is larger than 95% of the index's existing components. Needless to say, that would have a major impact on any index. The reality is Tesla, big company by market capitalization, over $250 billion company. That's a pretty sizable company. So understand that that's what the index funds are going to be forced to do, is to buy Tesla at a very high price, which then leads us to sort of our second concern, is that then you want to certainly be aware of the run-up that could potentially happen. Remember, the Tesla is up 500% over the past year, 250% year to date. And again, we'll look back on a little bit of history, back to the dot-com days. That seem to be doing that a lot in this particular segment, particularly with the conversation about those 5 largest companies in the index. But the year is 1999, and the company is Yahoo. And in 1999, Yahoo went up 64% in the 5 days between the announcement of the inclusion in the index and the actual inclusion. The message there is that when you have an up-and-coming company that can go into the index, you should probably own a little of it over time. But if all you own is the indexes, you don't actually own any Tesla today. And by the time you own Tesla, you're going to be owning it and purchasing, or at least the index investment is going to be owning it at a price that is much higher than what it is, and potentially even much higher than it currently is today. So just be aware of some of the limitations of owning an index fund. You know, you've got a large and successful company like Tesla that's clearly turning heads, and you don't own it until the day when you do, and unfortunately it may very well be that you're going to own it at a much higher price. So just be aware of that, how the indexes work, what they represent, and what they sometimes get forced to do. And we think that the Tesla example is another good example, much like the Yahoo example of 30 years ago, of those implications that can happen when a company gets included into the index for the first time. So some interesting perspective on Tesla and its role in the index, and how that might very well affect your underlying investments, particularly if you own a good amount on the index fund. One last grab bag that we didn't get to, we'll throw it in here at the end of the program. It's a concept that we've talked about before, but most really don't appreciate, and that's the notion that typically your spending is highest in the first few years of your retirement. Most think it's those later years when your health gets bad and you've got all of that you need to kind of deal with and pay for. But the reality is that what you actually see is that if you are younger, you are more active. If you're more active, then that means you're going to spend money. And the older you get, sort of the less active you get, and the less money you get. In fact, we've got the latest study that actually puts some numbers on it. So some parting thoughts before we wrap the program up. The average retired couple spends 23% less money in their 6th year of retirement compared to what they spent in the first. So interesting number to ponder on as you plan your retirement. We'll wrap it up and get on out of here. Thanks for listening to the program. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning here on News Radio WFLA Orlando 96.9 The Game.